Welcome to the Pro Ticker Deep Dive.
It is great to be back.
We have a monumental show ahead of us today, and I really don't use that word lightly.
No, this is a big one.
Usually when we sit down to unpack an earnings report, we're looking for, trends, subtle shifts, maybe a surprise margin beat here or there, but what we're looking at today, specifically with Amazon's Q4 2025 report, this is something else entirely.
It really is. It feels less like a standard earnings report and more like a manifesto, a declaration of intent for the next decade.
Exactly. We're looking at this massive paradox that seems to be just, melting Wall Street's brain right now.
It's a huge contradiction. On one hand, you have a company that just crossed a truly historic milestone, $700 billion in trailing 12-month revenue.
$700 billion. Just pause on that number for a second.
It's staggering. And they delivered a record-breaking holiday season. The machine is humming. By every traditional metric you could look at, this should have been a victory lap.
And yet, as we're recording this, the stock is getting absolutely pummeled in after-hours trading. I think it's down, 7, maybe 8%?
Something in that range, yeah. Investors are basically heading for the exits.
So the mission for this deep dive is to answer a really simple question. Why? Why is a company that is making money hand over fist being treated like it just announced a complete disaster?
Well, it really all comes down to a clash of narratives.
Yeah.
For the past, say, 18 months, investors fell in love with what you might call efficiency Amazon.
Right. The cost-cutting Amazon.
Exactly. They were streamlining, they were laying people off, they were boosting margins. It was safe, it was predictable, it was profitable, and Wall Street absolutely loved it. But yesterday afternoon, efficiency Amazon just left the building.
And investment Amazon kicked down the door.
Kicked down the door and set fire to the furniture.
And when you say investment, you're being polite. We are talking about a number that caused a collective gasp on the conference call. A number we're going to tease right now, but we'll unpack it fully later. $200 billion.
The CapEx bombshell. That's the one. $200 billion in capital expenditures guided for 2026.
Just to frame that, that is, without a doubt, the largest infrastructure investment program in the history of the technology sector. It might be one of the largest in the history of modern business, period. And that sticker shock is what's driving this entire sell-off.
It really is. It just raises this ultimate question. Is this a reckless, out-of-control spending spree that's just going to burn shareholder cash for years to come?
Mm-hmm.
Or is this the single smartest bet in tech history, a move to secure total dominance for the next decade?
So here's our roadmap for the hour. First, we have to start with the good news, the Q4 numbers themselves, the revenue beats, the reacceleration of AWS, and the absolute juggernaut that is their advertising business. We have to understand the engine before we can look at the fuel bill.
Then we're going to do a forensic accounting of that $200 billion number. Where's that money actually going? Because I'll tell you right now, it's not just for buying servers. It's way more complex.
That leads us right to the secret weapon. We're going to get a little technical on chips. We need to talk about Trainium, this thing called Project Rainier, and the war for AI independence that Amazon is basically waging against the NVIDIA monopoly.
We also can't ignore the cash cow, the retail side. How are they paying for all of these shiny new data centers? And spoiler alert, it involves a lot of robotic efficiency and, unfortunately, some pretty significant layoffs that we need to talk about.
And then finally, we'll reach a verdict. Is Amazon a value trap right now, or is it a rocket ship getting ready for launch? So let's dive in. Section 1, the headline numbers. Because if you just read the top line of this report, you'd think the stock should be up 10% today.
You really would. If you just strip away all the forward-looking guidance and just look at what Amazon actually executed in the fourth quarter of 2025, it was stellar. Top-line revenue came in at $213.4 billion.
Let's just pause on that scale for a second.
Yeah.
$213 billion in 90 days.
It is a staggering amount of money. And the consensus estimate from analysts was, somewhere around $211 billion. So they beat expectations by over $2 billion. That's year-over-year growth of about 13.6%.
And that's the number that pushes the trailing 12-month revenue past that $700 billion mark we mentioned. You start comparing that to a country's GDP at that point.
Oh, absolutely. If Amazon were a country with $700 billion in revenue, it would be roughly the 20th largest economy in the world. It's bigger than Switzerland. It's bigger than Poland. It is, for all intents and purposes, an economy unto itself.
And it's not just empty revenue, right? They're actually making money on it.
They are. The core business is humming. Operating income landed around $25 billion for the quarter. Their own guidance had been a range of 21 to 26 billion, so they landed right near the top of their own expectations. This shows that the core operations selling stuff, shipping stuff, and hosting data are fundamentally very profitable.
But, okay, let's look at the earnings per share, the EPS. It came in at $1.95, and this is where we see the first, maybe a little crack in the armor, right?
This is a classic case of Wall Street psychology. So $1.95, technically, it beat some estimates, but a lot of the big institutional analysts, they viewed it as inline. Now, normally hitting your numbers is fine, but you have to remember the context here.
Right.
For the previous 8 quarters, that's 2 full years, Amazon has been absolutely crushing earnings estimates. I'm not talking about beating by a penny. I'm talking about beating them by 20% or more, quarter after quarter.
The market got addicted to this surprise. It got addicted to the beat and raise cycle.
Exactly. They priced in another massive beat. So when Amazon comes out and just says, here you go, we hit the number right on the nose, the market reads that as a disappointment. It signals that the easy money era of just cutting costs to boost profits is over. And specifically, it signals that new costs are starting to creep up.
And one of those costs is depreciation, which I know is a boring accounting term, but it is about to become very, very important to our listeners.
It is absolutely critical. So when Amazon buys a server or builds a warehouse, they don't expense that entire cost immediately. They spread it out, they depreciate it over the useful life of that asset. As they buy more and more equipment, and we're about to talk about how much they're buying, that depreciation charge on the income statement gets bigger and bigger, and it eats directly into the reported profit.
So that $1.95 EPS is basically telling us that the bill for all the past investment is starting to come due.
Precisely. The depreciation bill is arriving.
Okay, so let's break down where the money actually came from in Q4. We usually visualize Amazon as having sort of 3 main engines.
Right. You've got North America retail, you got international retail, and then you have the big one, AWS, the cloud business.
So how did the retail side hold up? Because we've heard so much about the consumer slowing down, inflation, all of that.
Well, the consumer definitely showed up for the holidays. North America retail revenue was up 10% to about $115.6 billion. International was up about 8 or 9% to $43.4 billion. That's solid growth, near double digits on a massive, massive base.
But the star of the show, and the thing that usually drives the stock price, is that third engine, AWS.
AWS was absolutely the highlight. Revenue is up 21.6%, hitting $35 billion for the quarter.
Now, we really need to contextualize why 21% is such a huge deal. Because if we rewind the clock to, say, 2023 or even early 2024, the whole narrative was very different.
Oh, it was gloom and doom. The narrative was all about cloud optimization. Every company was looking at their AWS bill, freaking out and trying to slash their usage. Growth had slowed to, a crawl. Investors were genuinely worried that the cloud market was saturated.
So seeing it reaccelerate, and not just by a little, but back over 20%, that's a major signal.
It is the definitive signal that the optimization phase is over and the build phase is back on. And specifically, it's the AI build-out. That reacceleration is almost entirely driven by overwhelming demand for generative AI and model training compute.
Okay, so if I'm sitting here listening to all this, I'm thinking, revenue is beating, the cloud is booming, the core business made $25 billion in operating income. Why on earth did the stock sell off 8%?
Because the stock market is a forward-looking machine. It doesn't care about the victory lap you just ran. It cares about the marathon you just signed up for tomorrow. And Amazon just told investors that the entry fee for that marathon is $200 billion.
Which brings us right to Section 2, the CapEx bombshell.
This is the number that just sucked all the oxygen out of the room during the earnings call. You could almost feel it.
Let's put this $200 billion figure into perspective. How does it compare to what they've spent in the past?
Okay, so in 2024, Amazon's capital expenditures were roughly $54 billion.
Okay, $54 billion. Manageable.
Then in 2025, they ramped it up significantly to $125 billion. That was already making people nervous, seeing that big jump.
Right.
But now, for 2026, they are guiding to $200 billion. That is nearly a 4 times increase in annual spending in just 2 years.
It's a vertical line on the chart. It's not a curve, it's a wall.
It absolutely is. And to compare it to their peers, because look, everyone is spending on AI right now. Google is projecting around $180 billion for their spend. Meta is guiding up to maybe $135 billion. Amazon is looking at everyone else's pile of chips and just saying, I raise. They are outspending everyone.
It is the largest infrastructure investment program in the history of the tech sector. And frankly, it's just incredibly risky.
It is phenomenally risky, and you see that risk reflected immediately in a metric called free cash flow.
Let's unpack that. Free cash flow, or FCF. Why does Wall Street obsess over this number so much?
Free cash flow is basically the truth serum of corporate finance. It's the cold, hard cash you have left over after you pay for all your operations and all your new capital equipment. It's the money that actually truly belongs to the shareholders. It's what you can use to pay dividends, buy back stock, or pay down debt.
And historically, Amazon has been a cash-generating machine.
A monster. In late 2024, their trailing 12-month free cash flow was almost $48 billion, a massive war chest of cash. But by late 2025, after ramping up the spending, that number plummeted to just $14.8 billion.
Ouch. From 48 down to 14, that is a massive, massive drop.
It's a collapse. And it is entirely because the line item, purchases of property and equipment, surged by over $50 billion year over year. Investors look at that and they say, you are taking our money that could be used for buybacks or dividends, and you are literally burying it in the ground. You're turning cash into concrete and silicon.
And it's not just their own cash, right? They're borrowing money to fund this.
They are. Back in November 2025, they raised $15 billion in a bond offering. Now look, Amazon has a pristine credit rating, so they can borrow money very cheaply. But the fact that they are tapping the debt markets at all tells you that they need the liquidity. They are truly betting the farm on building out this AI infrastructure.
It really feels like a poker game where Amazon just looked at their hand, looked at the table, and shoved all in. This is it. We're doing this.
It is a very high-stakes game.
Yeah.
And the immediate reaction from the market was fear. You also saw it reflected in their Q1 2026 guidance. The revenue outlook was okay, somewhere between 173 and 178 billion. But the operating margin guidance came in at around 10.8%. And that was below what the street was expecting.
So profits, as a percentage of sales, are getting squeezed in the short term.
Yes. They cited some foreign exchange headwinds. A strong dollar makes international sales worth less when you convert them back. But the real story, the hidden story in that guidance is two words: capacity constraints.
And this is where we get into the really fascinating part of this whole deep dive, because usually when a company says capacity constraints, it's a bad thing. It means they messed up their supply chain or they can't make enough widgets. But in this case, it sounds different.
It is very different. This brings us to Section 3. AWS and what some analysts on the street are now calling the passive slowdown.
Passive slowdown. That sounds like a complete oxymoron. How can you be passively slowing down?
It means they're growing, but they're growing slower than they could be because they physically cannot plug in the computers fast enough.
Wait, say that again?
Andy Jassy, the CEO, he explicitly stated on the call that AWS revenue, which, remember, grew at a fantastic 22%, could have grown even faster. They literally ran out of capacity to sell.
So you're telling me customers are lining up with cash in hand saying, give me more AI compute, and Amazon is saying, I'm sorry, take a number, we're sold out.
That is exactly what is happening, and the proof is in the backlog. The backlog, which is the total value of contracts that are signed but not yet billed, is now over $200 billion.
$200 billion in backlog. That's an insane amount of pent-up demand. It's more than a whole year of AWS revenue just waiting to be turned on.
It is. It completely validates the demand side of this equation. The world wants what they're selling. But the supply side is an absolute nightmare. The bottleneck isn't just about getting chips from NVIDIA or even manufacturing their own. The bottleneck is physics. It's electricity.
Power. We are literally talking about the power grid.
We are entering an era where data centers are consuming energy on the scale of heavy industry, like a steel mill or an aluminum smelter. Amazon added 3.8 gigawatts of new power capacity in the last 12 months alone.
Can we try to visualize 3.8 gigawatts? Because that sounds like a sci-fi number to me.
It's massive. So a standard large nuclear reactor produces about 1 gigawatt of power. So in just 1 year, Amazon effectively added the equivalent of nearly 4 nuclear reactors worth of power capacity to their operations. And that's more than any other cloud provider added.
And they're not stopping there.
Not even close. Jassy said on the call that they expect to double their total power capacity again by 2027.
Doubling it again from this already massive base.
Think about the logistics of that. You aren't just a tech company anymore. At that point, you are a power infrastructure developer. You are dealing with utility companies, you're building substations, you're running high-voltage transmission lines, you're designing massive cooling systems, you're negotiating with local governments about grid stability.
You know, it reminds me of the early days of the railroad. You had to
Yeah.
lay all the track, you had to blast through mountains and build bridges before you could even think about selling a single ticket. But laying that track is incredibly expensive and slow.
That is the perfect analogy. And just like the railroads, once that track is laid, you have an enormous competitive moat. If you have the power capacity locked in, if you have the substation built and the utility contract signed, and your competitor doesn't, you win the big AI contract. You are literally the only train in town.
Speaking of winning contracts, we have to mention the government deal. The $50 billion announcement that sort of slipped under the radar in all this CapEx chaos.
Yes, this is a huge one. It's specifically for U.S. government agencies. This is for what they call their top secret and secret cloud regions. They are investing $50 billion to build 1.3 gigawatts of compute capacity specifically for national security, defense, and research.
So this isn't for hosting Netflix or Instagram. This is for something else entirely.
No, not at all. This is for the CIA, the Department of Defense, the NSA. This is mission-critical national security infrastructure.
That sounds like incredibly sticky revenue. I mean, the CIA isn't going to switch cloud providers next week to save a few bucks on a Black Friday deal.
Precisely. The barriers to entry for top-secret cloud are enormous. You need specially cleared personnel, you need physically secured facilities, you need specific audited hardware supply chains. Once you win that business, it's almost immune to economic downturns. If the economy crashes, people might buy fewer sneakers on Amazon.com, but the government does not stop spying.
So, okay, they have the demand, they have the backlog, they are building the power infrastructure. But let's talk about the actual brains of the operation, the chips themselves, because Amazon isn't just buying chips from NVIDIA like everyone else. They're trying to do something much, much bolder.
And this brings us to Section 4, the hardware war. And this is where Amazon is really trying to break the NVIDIA monopoly.
We all know NVIDIA has been the kingmaker in this whole AI boom. Their margins are, they're just insane, 60–70% on their chips. That's the NVIDIA tax everyone talks about. Every time Amazon buys an H100 or a Blackwell chip, they are paying a massive premium to Jensen Huang.
Right. And if there's one thing Amazon hates, it's paying premiums to a supplier. It is in their corporate DNA to cut costs and own the entire stack. Jeff Bezos always had that famous saying, "Your margin is my opportunity." Well, NVIDIA's 70% margin is Amazon's gigantic opportunity right now, and their answer is a chip called Trainium.
Trainium, it sounds like a transformer or something.
It's their custom AI training chip designed completely in-house by Amazon's Annapurna Labs subsidiary in Israel. They're currently rolling out the second generation, Trainium 2.
So the big question is it actually any good? Or is it just the generic store-brand version of a real NVIDIA GPU?
From all the data we're seeing, it is actually very, very competitive. Amazon claims it offers 30–40% better price performance than comparable GPU instances from NVIDIA.
And price performance is the key phrase there, right? It might not be faster in raw absolute speed than the newest, most expensive NVIDIA chip, but per dollar spent, you get more work done.
Exactly. And if you're a startup trying to conserve cash or a big enterprise training a massive model, saving 40% in your compute bill is the difference between profitability and bankruptcy. And people are voting with their wallets. The Trainium business is growing 150% quarter over quarter. It is already a multi-billion-dollar business on its own.
And it's not just small players using it. We have to talk about Project Rainier. This sounds like a Manhattan Project level effort.
It basically is. Project Rainier is a massive AI compute cluster located in, I believe, Indiana. It contained nearly 500,000 Trainium 2 chips all linked together.
500,000 chips in one single cluster.
And they're scaling it to 1 million eventually. It is, by some measures, the largest single AI compute cluster on the planet. And the primary partner using it right now is a company called Anthropic, the creators of the Claude AI models.
Okay, let's connect the dots here because this circular economy thing they've built is fascinating. Amazon invested about $8 billion into Anthropic, right?
Correct. Amazon gave Anthropic a huge pile of cash.
And Anthropic, in turn, needs massive amounts of compute power to train their next-generation models to compete with OpenAI.
So Anthropic takes that cash from Amazon and pays it right back to Amazon for cloud usage, specifically on this Project Rainier cluster full of Trainium chips.
So Amazon gets to record that as AWS revenue.
And then they use that revenue to help fund the manufacturing of more Trainium chips.
It sounds a little bit circular, like you're just passing the same $20 bill back and forth between friends.
Well, skeptics would definitely call it round-tripping revenue, and there's an element of that. But there is a much deeper strategic reality here. It validates the hardware. If Anthropic, who makes one of the world's best and most sophisticated AI models, can successfully train their models on Trainium, then any enterprise customer can. It proves at the highest level that the hardware works at the absolute frontier of technology.
It's a huge endorsement because the skepticism has always been, sure, Amazon has their own chips, but can they handle the really hard stuff that NVIDIA can?
And Project Rainier is the answer to that question.
Yeah.
The answer is, yes, they can. And there's another strategic moat here, too. Look at the competitive landscape. Google mostly uses their own TPUs in their cloud. Microsoft's Azure is heavily reliant on NVIDIA. AWS has a hybrid approach. In their cloud, you can use NVIDIA GPUs, or you can use Trainium chips, all in the same high-speed network fabric.
So they aren't forcing you to choose one or the other. You can mix and match.
Exactly. It dramatically lowers the switching cost for customers. You can start your project on NVIDIA because that's what your engineers know and all the software supports it. Then, when you're ready to scale up and save money, you can migrate parts of your workload over to the cheaper Trainium instances without having to leave the AWS ecosystem. It is a very clever way to slowly wean customers off the extensive NVIDIA drug.
And they even teased Trainium 3 on the call, right?
They did. Coming late 2026 or early 2027, it's going to be built on a cutting-edge 3-nanometer process. And they're promising 4 times the energy efficiency of Trainium 2.
4 times.
That energy efficiency is the absolute key. Remember that power bottleneck we talked about earlier?
Yeah.
If you can get 4 times the computational work done for the same amount of electricity, you have just effectively quadrupled your data center capacity without having to build a single new power plant. That is the holy grail in this new era.
Okay, so that's the secret weapon, but all of this costs an insane amount of money. $200 billion. So where is all that cash coming from? Because they aren't just printing money in the basement.
Well, in a way, they actually are. They are printing it in their warehouses and on their website. And this brings us to Section 5, which is all about the cash cow, the retail and ads businesses.
It's funny because for years, the narrative was that retail was the low-margin break-even business. People said Amazon made no money on shipping boxes, but now it seems to be the stable, powerful engine funding all these risky bets.
It is incredibly resilient. Like we said, North America retail was up 10%. They had a record Black Friday and Cyber Monday. But the real story under the hood is something they call regionalization 2.0.
We've touched on this in previous deep dives, but explain how it's evolving and why it's so important for their profitability.
So it used to be a single national fulfillment network. If you ordered, say, toothpaste in New York, it might ship from a giant warehouse in Kentucky or Ohio. Now they've divided the country into 8 distinct self-contained regions. They try to keep the toothpaste you're going to order in a local New Jersey hub.
Which reduces the number of touches per package. How many times a human or a robot has to handle it on its journey.
And it drastically reduces the travel distance. Less fuel for trucks and planes, fewer driver hours, less wear and tear. This lowers what they call the cost to serve a customer. And they've now lowered that cost for the 2nd year in a row. That efficiency translates directly to operating income. And they're finally starting to crack the grocery code, too. They've expanded same-day perishable delivery to over 2,300 cities.
I've noticed that. You can get a single banana delivered in under 2 hours in a lot of places now. But let's be honest, the real profit machine isn't the bananas themselves, is it?
No. It's the ads they sell on the website right next to the bananas.
The ad machine.
Their advertising revenue was roughly $21.2 billion in Q4 alone. That was up almost 23% year over year.
Wait, $21 billion in a single quarter? That is almost $100 billion a year business just in ads. That is bigger than YouTube.
It is a monster. And you have to remember, ad margins are incredibly high. Unlike selling a blender, where you have to buy the blender, store the blender, ship the blender, with an ad, you just display some pixels on a screen. The cost of goods sold is near zero. That profit is pure, high-octane fuel for the AI furnace.
And they are expanding that ad inventory, right? It's not just on Amazon.com anymore.
No, this is a key new growth area. They now have partnerships with Netflix, with Spotify, with SiriusXM. They're using Amazon's rich shopping data to sell ads on other people's platforms. Plus, they finally turned on ads for their own Prime Video service, which now reaches 315 million monthly viewers. That's a huge new source of high-margin revenue.
So if you're wondering how they can possibly afford a $200 billion CapEx bill, it's partly because they are quietly becoming one of the biggest and most powerful advertising companies in the world.
That's a huge part of it. But there is a darker side to the funding equation. And we have to talk about the bureaucracy busters, as Jassy calls them.
The layoffs.
Yes. Amazon is in the process of cutting approximately 16,000 corporate roles. And this follows about 14,000 cuts from the previous round. That's 30,000 corporate white-collar jobs gone in a relatively short period.
And CEO Andy Jassy is framing this as an effort to reduce bureaucracy.
He talks about flattening the organization and increasing the ratio of individual contributors to managers. He says he wants fewer meetings, fewer layers of approval, and faster action.
But let's be very clear about the trade-off that's happening here. It's not just about speed.
No, it is a ruthless strategic reallocation of resources. They are reducing headcount in legacy corporate roles, think middle management, HR, some of the traditional retail divisions, to free up cash to hire thousands of AI engineers and pay for data center operations.
They are literally swapping people for GPUs.
In a very real economic sense, yes. It is a fundamental pivot from a labor-heavy corporate structure to a compute-heavy infrastructure structure. They are betting that software, and increasingly AI itself, can replace a significant layer of human management and bureaucracy.
So we've looked at the good numbers, the terrifying spending, the secret weapon chips, and the cash cow funding it all. Now we have to answer the big question. Section 6, the verdict. Is this a value trap or a rocket ship?
Let's start with the bear case. It's pretty straightforward. Why did the stock drop 8%?
Because $200 billion is a terrifying, almost incomprehensible number.
It is. The spending is astronomical. We see margins in Q1 compressing down to 10.8%. Free cash flow has all but disappeared in the short term. And frankly, I think there's a bit of AI fatigue setting in among investors.
They're tired of hearing, trust us, the profits are coming in 2028. They want to see the profits now.
Exactly. They see a company that appears to be burning cash and taking on new debt, and they worry that this whole AI boom might be a bubble. What if the demand isn't infinite? What if we reach a plateau on what these large language models can actually do? If that happens, Amazon is left with billions and billions of dollars of empty data centers and rapidly depreciating ships.
That's the nightmare scenario, a field of dreams moment. If you build it, they don't come.
But then you have to look at the bull case.
The revenue scale. $700 billion and still growing at a healthy clip.
The revenue is growing, yes. But more importantly, AWS is reaccelerating up 21% despite being supply constrained. That suggests the demand is real, it's robust, and it's probably even stronger than the reported number. The $200 billion backlog is real.
And the margin reset, that compression we're seeing in Q1, the bulls would argue that is entirely temporary and strategic.
They'd say it's an investment, not a problem. Because once the data centers are built, the heavy spending phase stops, or at least it plateaus, and the cash starts flowing like a tidal wave. It becomes a utility model. You build the power plant once, and then you just sell electricity for the next 50 years with very high margins.
And the stock's valuation isn't completely crazy, right? Even before the drop.
No, it's trading at roughly 33 to 35 times earnings. For a company that is projected to grow its earnings per share at 20 to 30% annually over the long term, that is a perfectly reasonable price, which is why most analysts still have price targets in the $295 to $308 range.
Which implies something like 25 to 30% upside from where it's trading after this big drop.
So it really comes down to a binary outcome. It has become a show-me story. Amazon has to prove that this $200 billion spend will result in massive, undeniable cloud dominance. They have to prove that Trainium is a legitimate, large-scale competitor to NVIDIA. They have to execute.
It feels like Amazon is transforming right before our eyes. It used to be the everything store. Then for a while, it was the everything store plus the cloud.
Yeah.
Now, I don't know what it is.
Now it is an infrastructure superpower. They are building the physical and digital backbone of the entire AI economy for the Western world.
So let's wrap this up. We saw a record quarter revenue beating estimates, AWS accelerating in a huge way, but we also saw the biggest gambling spree in corporate history announced with that $200 billion CapEx guidance.
It is a genuine pivot point for the company. Investors have to decide if they trust Andy Jassy's vision for the future as much as they trusted Jeff Bezos' vision 20 years ago. You have to remember, Bezos spent years and years losing money to build the warehouse and logistics network, and people called him absolutely crazy back then, too.
And before we go, I want to leave you, the listener, with one final provocative thought. We talked a lot about power constraints. We talked about Amazon adding gigawatts of power and doubling their entire capacity by 2027.
They're becoming a major player in the energy market, whether they want to or not.
So if the ultimate bottleneck for the future of technology, for the future of intelligence, isn't chips but raw electricity, does Amazon eventually just become an energy company?
That is a fascinating question. If you control the power generation and the grid that is needed to run the collective intelligence of the world, are you still a tech company, or have you become the most important utility in human history?
Are they building the infrastructure of the future, or are they just building the world's most expensive electric bill?
I think we are going to find out the answer to that in 2026.
We certainly will. Thanks for joining us on the ProTicker Deep Dive. We'll catch you next time.